Okay, good afternoon, everyone. This is Jason Putnam Gordon. Thank you for attending today's webinar. Today we're going to be going over Series A funding, and we're going to be exploring the basics of that. We'll be talking about, what it is, where it happens, when it happens, and how it happens. It's pretty cool. We circulated requests to get some questions ahead of time. We got a few of those. We're going to try and work them in today's presentation. I have to say I'm pretty excited for hosting today. I've given this presentation a number of times, but this is the first time in webinar form. So, with that in mind, please bear with me. If there are any snafus, we'll get them fixed. And the other thing is that I'm battling a cold today. The last time I did a webinar was about a month ago. I was battling a cold. I got better then, and I don't know. Maybe I just need to stop scheduling these things and I can stay healthy. But if you hear me sniffing or sneezing, I apologize. I'll try and put myself on mute. And right now I've taken the cough drop out of my mouth because it's a bit distracting, but I may need to put one back in because to talk for about an hour straight ain't that easy. So again, we've gotten some responses. It looks like we've gotten about 38 people or so out of 101 that registered, so that's pretty good. And we're going to get started. Now, a couple things. You'll see I've included a sort of a draft generic term sheet. We're going to be going over that today. It's from the National Venture Capital Association, and it's a model document. We're going to talk about that a little bit as we move forward. And then I also made available the slides, which you should see on your screen, and which are available. You can pull each of those items out of the handout section in the sort of lower right-hand corner, or maybe it looks like it's sort of about midway on your dashboard. So let's get rolling. Let's going to start with some important caveats. This is what we always go over whenever I do one of these presentations. Today's discussion is going to be general information. It's not legal advice. We'll be discussing the basics of how things work. We'll be talking about issues and then rules and exceptions to those rules and exceptions to the exceptions, but we're not going to be able to get through all the scenarios to have this constitute actual legal advice for your particular situation. So even if you ask me a question, my off-the-cuff response is not going to be advice for you. It's just going to be some information of how we'd maybe address the issue. That being said, my goal is to be helpful for you, give you guys some concrete examples of how things happen and how we deal with things in the venture capital realm. So let's move along. I'm going to give you an outline or an overview of how we proceed on these things. I want to first start by going over our respective backgrounds. So I'm going to tell you a little bit about myself, tell you a little bit about my practice, what we do here at Putnam Gordon PC, why we like working with startups. I want to learn a little bit about you all, so maybe if you could respond in the question section, I'll try and follow along. But I got about 4 or 5 windows open and a handout in front of me, so multitasking to the max here, which is pretty cool. But I want to be able to sort of tailor this discussion to what it is that you all are interested in. So feel free to write questions. I'll try and answer them as we move through everything. If we don't get to them, there will be some time at the end. So first we'll start out with our backgrounds. We'll go through some basic fundamentals for startups. I think that's always very important to make sure that we're all on the same page. We'll talk about financing options generally. We'll talk a bit about the financing life cycle of a startup. So there have been some questions about, where does seed financing fit in? How do you access, angel investors, how they fit in and work with, venture capitalists and venture rounds. We're not going to go into a lot of depth on that. In fact, actually today we're not going to be able to go into, super in depth, but I at least want to hit on some of those things and give you the general sense for how things get done. So hopefully that'll be helpful. And then the other thing is that we're going to go into why we're all here, Series A financings. And when we do that, we'll be taking a look at the term sheet and walking you through that. All right, let's keep chugging along. Looks like people are still trickling in. If you just trickled in, you haven't really missed that much. Again, what we talk about is general information. It's not legal advice. So let me give you a little bit of background information about who I am and why I'm hosting this. I've been practicing law for over 10 years now. I'm a corporate and securities attorney. I started my own firm almost exactly 5 years ago at this point. So I was with a really large technology-focused firm. Decided that wasn't a good fit for me. Wanted to be an entrepreneur myself. So I started my firm. There are two attorneys, and we have Alan, the admin, who is also listening in. And if you see questions from him, those are plants. You can kind of take them with a grain of salt. But we love working with startups. And when I say startups, I mean emerging growth companies. Those are generally technology companies that require a fair amount of capital to grow and scale. We also work with mid-market companies, but that's not going to be the focus of today's conversation. We're based here in San Francisco, but we work with clients throughout the world. In fact, I was just on a call earlier today with a client who's based in the UK. We've got clients, all over Europe, clients in Australia, and we love working with them. We're really lucky because the Bay Area is, the heart of Silicon Valley, and people come from all around the world to do business. We love working with entrepreneurs. We do that generally as outside counsel, in addition to the corporate securities work we do. So that means we frequently act as, sort of the legal gatekeeper. We help pick and identify issues and help get them resolved for you, either directly or through, attorneys who we know and have developed relationships with over the years. And I'd like to always give a fun fact. In my spare time, I like to skydive. I've got over 1,200 jumps. We got second place this year at Nationals in October. And I think, one of the really fun things, and one of the reasons why I like having my own firm and why I identify with my clients, is that at the heart, I'm an entrepreneur too. What I do day in and day out is basically identify people's needs, albeit legal needs, and then work to fulfill those needs, either directly or placing them in contact with other folks who are well positioned to help them out, and to do it efficiently and cost effectively. So I want to learn just a little bit about you. Maybe if you guys could just respond in and let me know, what you do. So I see some folks who want to know where we are. We're on slide 5 at this point. And hold on one second. I just got getting a call in from Alan. Okay, Alan says that for some reason, the screen that I'm sharing is not working. So I'm going to stop showing the screen and restart it and see whether or not we can get that working. Okay, seems to be working again. This is why I've got sort of my engineer, or at least that's the hat that he's wearing today, to make sure that this technical stuff gets done. Thanks, Alan. So we are on slide 5, and I want to learn just a little bit about you guys. Who here is in a startup? If you just kind of chime in with a why, it would be good to know. All right, we got Harrison, a few other folks. Oh, fantastic. Okay, and who here is a founder? Okay, thinking about founding, fantastic. Who here has received some sort of funding, whether it's outside funding, so friends and family, angels, maybe you've done a Series A round. We got some folks with some seed funding. We've got some folks who have gone through the process before. Okay, fantastic. And I take it you all are interested in venture rounds, because that's what's going to be the topic of discussion today. And let's talk about that. Let's talk about who should be watching this. So I think probably the people who will get the most value out of today's webinar will be those folks who have either started a startup or about to start a startup, and they're looking at raising funding. Primarily venture funding, but I think even if you're just at the angel round, I think you're going to get some real value out of this. And the reason why I say that is something I say repeatedly throughout all my work with my clients, is that in order to get to where you want to go, you got to start there and then work backwards, right? So, if you want to get and have a successful exit, whether that's an IPO or whether that is a merger or an acquisition event, which actually happen a lot more than IPOs, then you got to know the process. So if you're looking a couple steps ahead, that's okay. That's good. You'll still get value out of this. So we're just going to touch on just some really high-level fundamentals. And, you know, I think I started earlier by talking about what this is geared towards. Okay, we're talking about emerging growth companies. We're talking about generally technology companies that require a fair amount of capital. When I say that, we're talking in the millions of dollars range. And the reason for that is that that's what's necessary for them to build out their technology, build out their teams, whether they're sales teams, technical teams, to go to market and be able to capitalize on either a new market or refine an existing one. So two examples I always like to give sort of is, take Uber, for example. They identified more or less kind of like a new market, i.e. Ride sharing, or, they may not have been exactly the first, but they're certainly the first to really get some traction. Versus Google. Google wasn't the first search engine, but, Yahoo was around. But they came up with a better mousetrap as it comes to search engines. So that's who we're talking about. We're not talking about companies that are only going to require, $500 or $1 million or $2 million to grow and scale. We work with those companies. We love them too. Sometimes they have special niches that allow them to be quite lucrative. But we're talking about folks who are going to need to raise institutional capital from venture investors. So let's kind of roll on. So entity formation. Okay, typically in this situation, and again, this is not legal advice, it's general information, but what we see is a Delaware C Corp. There are some reasons for that. I won't get too into depth on them, but they involve, Delaware has generally a better, has a few things. It has a better Secretary of State's office for processing documents. It has better case law, more protection for directors and officers. And it also, getting into just the Delaware corporate statutory law, it makes it easier to do business there. Some of the other fundamental concerns are who gets what with regard to the founders, and what happens if somebody leaves. Typically, we see vesting in place. We'll talk a little bit about that later, but that's with founders. And so basically that's so that if one founder leaves early, they won't be walking out with a huge chunk of the company. And then some of the other things that come up is, what protections is it possible to get in place against later investors? So where does this come up? Well, founders will come to me and they'll say, well, look, I know these VCs, man, they're sharks. And what I want to do is I want to be able to get into place, an exploding voting rights agreement so that, I could never be ousted out. And I say, and I can totally understand, and I think that's a legitimate concern. The issue that comes up with that, though, is that usually the investors are putting in a fair amount of capital, and if they are going to do that, they're going to want to have some say. And so unless you are have demonstrated a very high level of success and your company is a super hot investment, the investors are going to want you to cut that out. So, sort of typically when we would actually see those things be put in place is later on before the company goes public, not necessarily at the outset. And if you put those in early, you're potentially wasting your time and money because you're going to have to get them cut out. And we can talk about that a little bit later. Bear with me one second. Again, I have a cold, so let me just take a drink of water and I'll pop back in a second. Okay, sorry, I'm back. Again, working through this cold today. Hopefully my voice will hold up. So let's take a look at the big picture here. This is not necessarily the best graphic that I've ever done or seen, so if you guys are any graphic designers out there who can help me out, I'd be happy to potentially hire you. But, the big picture is, you've got this company and you're putting inputs into it. Okay, you're putting capital, which will come from your investors, and tangible assets like your ideas, and then, ideas and other IP, and then you'll have services, right? There are going to be technicians. These may be the folks who are doing the actual coding. There'll be sales and marketing folks. There'll be, legal teams and other folks who are all contributing. And what you want is you want all of their work to end up in the company so that the company can grow over time and, the company's value grows over time. Now, we're going to be focused on financings today, so let's just kind of take a quick look at the, sort of what the options are, and we'll kind of walk you through it, because these are really common questions that we get when people are considering an angel versus a venture round. So the way that it typically works for emerging growth companies, right, they've got this Delaware C Corp set up. Maybe they've got a couple ideas, maybe they're starting to do some prototypes, it's just a founder, maybe two founders. There's kind of a life cycle here. And I'm actually going to jump ahead 2 slides to come back, because I think this will actually be more helpful. The initial round of funding comes in sort of at the angel level, right? And it's typically called seed capital. So seed capital is basically the capital that is out there that gives you the initial team. It gets the initial team in place, so that team can develop the initial strategy, do some market research, get a business plan, maybe do a beta. That's what those ideas. That's where the sort of seed capital comes in. The venture rounds are a little bit beyond that. Okay, so seed capital is typically a few $100,000 to $1 million or $2 million, and it's kind of interesting because the amounts of capital that are necessary to be raised and the mechanisms by which we do it have changed over time. So initially, 10, 20 years ago, when you were building a technology company or even just a software company, you had to go out there and you had to put together your own server farm, and that cost millions of dollars, right? But now everybody, Amazon, Microsoft, other folks allow you to, put your, SaaS product in the cloud, and you can scale on their hardware, which is fantastic. So that means basically a few things. It means that companies sometimes don't need to raise nearly as much money, at least to get to market. And then the other thing, kind of along those lines, you don't necessarily need to have the venture investors in right away. And then the other thing too is sometimes you don't need to get venture capital investment. That's kind of a running theme throughout this discussion is, being strategic about who it is that you're raising money from, and how much money that you're actually raising. So let's keep cruising here. So, you're raising about $1 million or so. You're looking at sort of convertible debt, convertible equity. There's some questions that came in on that. You're raising between $1 million, $2 million, or $3 million. You're looking more at Series C, which is kind of like a Series A light, not really the topic of today's discussion, but certainly worth noting. And then, you're raising 2, 3, and these days more likely 4, 5, or 6 million. You're kind of looking at doing a Series A round. So let's talk about the process, how you walk through that. Let's talk about the documentation. I encourage you to go into the handout section here and take a look at the term sheet that we've put in place. This is, again, just a form term sheet from the National Venture Capital Association. It's not a company-friendly document, so most of these terms are investor-friendly, but it provides a good guide for us to walk through. And so what we're going to do is we're going to walk through that as we're talking about the documentation. But let's talk about the process, okay? So, you formed an entity, you've built out a prototype, you've done maybe some seed stage fundraising from friends and family and or initial investors. How is it that you come across or you want to do a Series A round? Well, typically by this stage you've already identified some advisors, okay? And you're going to be working with those advisors. You'll be working with your board to determine it is the right business strategy to go this route, right? To do a venture round. And this is really important because, as folks know, the investors are savvy. Some people call them sharks. And so if you don't need to have them involved, if you can bootstrap it, you can build a very successful company without them, that's what you should be doing. But you can't always do that. Sometimes you need them. You need the money. So, you've already consulted with those folks. You determined it's the right business strategy. Now it's time to go out there and find some investors. Okay. Well, let's talk a little bit about this, and this is not necessarily on a legal. Um, this is not necessarily on a legal avenue. This is kind of more business issues, but you know, how do you get connected to those investors? Because we got some questions about that from Volkmar and I think Aaron and Ozan. Uh, well, you got to leverage the network that you've already built, right? So you probably know folks personally, maybe through LinkedIn. Um, what you want to be careful about, and this is on the legal side of things, is that you don't inadvertently engage in a general solicitation. And this applies both for the convertible rounds, the earlier seed rounds, and also um, for venture investment. And what that is basically is, they're excuse me, not just California, but the United States have securities laws. Okay, and it doesn't matter if you're a big company or a little company. You need to make sure you're in compliance with them. If you're not in compliance with them, then one, you may be obligated to give the money back, okay, which is a real problem if you've already spent the money. Or two, you may be required to register your company with, the Securities and Exchange Commission, which costs hundreds of thousands, or actually probably more realistically millions of dollars. So not complying with those laws can land your company being dead on arrival. In line with that, what you want to be doing is, and the basic the basic rule is, if you're going out there and you're raising money from the public, you need to register. Okay. Now, if you're doing a private transaction, you don't necessarily need to register, and what we look at is whether or not there's an applicable exemption. So you need to kind of stay within your network. This is, again, not legal advice, but just generally speaking, so that you don't inadvertently end up doing a general solicitation. Now, the network, and this is kind of one of the sort of interesting legal issues, your network isn't necessarily the people you know. It can be people you know who know people as well. And it's not particularly well defined. I mean, that's what keeps us in business. That's what makes my job complex. It makes it fun for me, but sometimes expensive for clients. So, you can go to pitch events where you know folks, if you've got, deep personal relationships or other relationships with them. And, I mean, that's kind of it. It's sales. You got to get out there. You can't do a general solicitation, so sometimes I see folks who just put something on their website saying, now taking investors. Well, that's going to be a problem, or potentially a problem. But, some of the things that we see, people use Angel List. I think there's a mechanism on Angel List where you can limit the view to accredited investors. I mean, that kind of thing, it makes you safer. Doesn't necessarily make you safe, but it gives you, puts you arguably in a better position to make sure you're not violating the securities laws. Similarly, there was a question about whether or not angels and VCs are interested in founders and companies that are based outside of the United States. The answer is yes, they are. Sometimes they will require that the founders come here. We've just been working with a company that was based in Greece. They had to re-domicile here in the U.S. And they ended up getting investors in Israel. So, kind of the key, whether you're doing a venture round or you're doing an angel round, is getting connected to the right investors. Those are investors who work in your space, so they can understand your technology, understand your idea. That can help them vet it. So, some of the other things that we talk about with clients is, generally VCs won't sign NDAs. This is a question that comes up all the time. So I think it's probably good to have, among other things in your slides, it's good to have, some language indicating that the slides are being provided confidentially, they're not to be shared. To a certain extent, that and $2 will get you a cup of coffee. $3 if you go to Phil's, like I sometimes do. So you need to be cognizant when you're giving these folks information, especially early on, that they've got portfolio clients. I mean, their job, right, is to make these investments and get, a 10x return on it over a period of 5 to 10 years. And understand that they may have other clients, or excuse me, other portfolio companies that do what you do, and really they are kind of interested in knowing what the competitive landscape is. So, You got to share some information with them, obviously, because you want to entice them, but you may not, and it may not be prudent to, kind of give away the secret sauce, at least very early on. And you'll see as we kind of walk through the docs that, there are some confidentiality provisions and other things that come up a bit later on. But, we're talking about as you're going out and putting together a pitch deck. Now, another sort of businessy thing, which is kind of important to keep in mind is, if you have the opportunity to pitch before the top VCs, you may not want to go there first. You may want to polish your pitch in front of somebody else or another group of investors, because there are a couple things. I mean, one, you want to look good because it's a little bit about sales, right? And then the other issue is that you don't necessarily want to get rejected by them, because then VCs can tend to be a little herd-like. So, if you get bumped by, the top firm or firms, other folks may not want to put their money in. Conversely, though, right, if you're hot and you're hot by the top firms, then you're in a great position from a bargaining perspective, right? Because there are going to be multiple people potentially fighting over investing in your company. That works out well. Okay, we're getting a fair amount of questions in, and I'm going to just keep plugging along, and then we'll save some time at the end. So I got a real quick question about why a pitch event does not violate the securities laws, and the answer is it depends on the pitch event. Okay, there's been some guidance recently by the SEC in the last year or two that basically, if it's put together by a network of individuals, and they're bringing in folks who they already know and have a relationship with, and they're only accredited folks there, that's probably not going to be a violation. So the answer is some pitch events may violate it. Okay, if you got some unsavvy, unscrupulous person who's just sort of like hosting these things, they don't really know anybody, they're posting in, let's say, the Wall Street Journal, come down and invest in startups. Okay, that's probably going to be a violation of securities laws. If it's put on by a venture capital firm and they're bringing in their investors or other folks who they've already had relationships with and they know you, it's probably safe, especially if those folks are only accredited investors. Let's keep plugging and chugging because we've got a fair amount of ground to cover. So we got this term sheet here, which we're going to walk through, and I've broken it up. There are about 5 or 6 documents that get put together total, right? You got the term sheet, you've got the charter, which is the amended and restated certificate of incorporation. You've got the preferred stock purchase agreement. You got investor rights agreements, voting agreements, rights of first refusal. Our next slides basically walk through the term sheet and kind of follow along, and we're going to talk about that stuff. So let's talk about the well, first let's talk about the that gets into the stock purchase agreement. Let's talk about the big picture first. Actually, the biggest thing that's up for grabs, and what some people have been questioning about, is the valuation. How is it that you determine the valuation? Well, it's all basically subject to negotiation. It is super duper critical because the valuation, the pre-money valuation, basically determines how much of the company you are selling. Okay, so how do you get there? Well, that is on the model that you and your CFO and or your business consultants put together, right? You think about what your market is, how much of the market that you can capture, and then what, if there are comparables out there, other folks who are already working in other startups in that industry, what their valuations are. I mean, you can take a look at those things, but all of those things are subject to negotiation. And it's critical. So, typically when we talk about a pre-money valuation, we're talking about what the value of the company is before the investors put their money in, okay? And we're talking about based off of all of the equity that has either been issued to date or that would be converted into equity. So convertible debt, probably a stock option pool for current employees, or excuse me, not just the current employees, but basically the stock option pool that you've set up or that you will be setting up. And then, You take that, let's say the pre-money valuation is $10 million, and you have issued 10 million shares of stock, or on a fully diluted basis, there are 10 million shares of stock. Well, then each share is worth roughly $1 a share. If your investors put in $2 million, right, they'll be buying roughly a share at $1 a share. So they'll have, on a post-money basis, the value of the company will be $12 million with, 2 million preferred issued and, 10 million common stock on a fully diluted basis. So roughly on a fully diluted basis, the investors would probably have 18% of the company in that sort of hypothetical. So let's just move back for a second and talk about what gets into the charter. If you're following along here, you'll see that is sort of the first thing that's up for grabs. We talk about dividends. Okay, there are a couple different types of dividends. All of the items that we talk about today are what gets negotiated in the term sheet, and they're things that you should work with your counsel on, and maybe your other folks who are on your board, so that you get them ironed out well. But we're just going to name them and briefly explain them, and then move on. So dividends, everyone's probably familiar with stock-paying dividends over time. Startups don't usually have dividends, but what you got to watch out for is whether or not the investors are pushing for cumulative dividends. So that means basically, even though those dividends have not been paid, they're still owed those dividends, each quarter. So if it's like 2% a quarter, let's just say, so that'd be like 8% a year. If and when dividends are paid, they would get paid all of those dividends first. So you can see how that would really drastically add up over time. The trend is not towards cumulative dividends, but sometimes they sneak in. Liquidation preferences. Okay, this governs what happens if you sell the company or the company goes under. Liquidation preferences, typically are 1x, so that means normally, between 1 and 2x or so, plus potentially the dividends that have accumulated if you have cumulative dividends. So what does that mean? That means basically you're negotiating over whether the investors get 1x, what they put in, so do they get their money back, or do they get like 2x? And then also whether or not it is participating or non-participating. So participating means that, let's say that the company, upon liquidation, is worth 5 times what the initial investment was by these investors. Do they get their money back, plus do they get to participate and get the money that they would have gotten if they had common stock? That's what we're talking about here. Anti-dilution protection. Okay, we're talking about down rounds. Okay, this is a hotly contested area. Basically this is about, if you sell stock to these investors at $1 a share today, but then something happens and the next time you raise money, you only do it at 50%, these guys don't want to get diluted. So, is there going to be a full ratchet? Are you going to basically make it as if they had paid 50 cents, or will there be some sort of weighted average, which is more common, so that their shares are really, it would have been as if they had gotten, they had paid 75 cents a share instead of $1, basically giving them more shares. That's what's hotly negotiated. And it's all subject to market power. Okay, this is a really big underlying theme. The hotter that your company is, okay, the more favorable terms you can have, basically. Veto rights, okay, so, we talked before about how it's all subject to market power. This is about the investors, whether or not they can say, well, yes, we understand that generally under corporate law you would be able to enter into this transaction, but we need to have our own special approval before you do it. And those are for things like acquisitions or amendments to corporate documents. These are protections that they want to get in place so that you can't, go off and sell the company without their special approval. Mandatory conversion upon a QPO. So that's a qualified public offering. Basically, these guys and gals are investing in your company because they want to make money. Okay, and when you're starting out, the idea of going public sounds like, oh, that's fantastic. We're going to make boatloads of money. Well, that's the goal. more often there's a merger or acquisition that's how you exit successfully for both you and the investors. But let's just talk about IPOs for a second. They want to make sure that the IPO is sufficiently lucrative for them. So it's about building in protections so that the IPO is big enough so that they actually make money off of it. And I'm just going to pause here for a second and take a drink of water because my throat is bothering me. All right, rolling right along. Okay, we talked about valuation, reps and warranties. Okay, so we're talking about the stock purchase agreement here. This is one of the documents. This document is, the document that governs the sale of stock to the investors. So it covers things like that, the mechanics of the transaction, attorney's fees, which are big, which are negotiable. How much of the investors' attorney's fees is the company going to be covering? And you may say, wait a second here. We're just a poor startup. Why should we be covering the investors' fees? And I think that is a legitimate position to take, especially since we normally represent companies. But the reality of it is that most of this money comes out of the proceeds from the investment. So again, we see it. We see it negotiated. It can easily be even to cover their fees because they're going to need to diligence the process. It could be $25,000 or $50,000, or you can negotiate it down. Just depends on how hot you are. And maybe some folks around here, they're saying, whoa, 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 how is that possible? We're just slapping together some documents. The way that this process works is, you start with your pre-term sheet diligence, right? You work with your investors, your current investors, your current advisors, determine it's right. Okay, you start negotiating a term sheet, and that's kind of what we're walking through today. But even after you get that term sheet signed, that ain't the deal. Okay, the deal involves a negotiation of all these other agreements, which we're talking about in diligence. And diligence can be quite time-consuming. Diligence involves you providing documentation that all of those pieces of the puzzle, if you guys think back a second ago to my poorly put together diagram, making sure that all of the connections, whether it's between your previous investors, whether it's between, the founders in the company putting in that IP, whether it's between those service providers, that there is all documentation correctly memorializing those relationships. Okay, so that involves, your counsel going through all the docs you got to date, or potentially all the docs you got to date, plus their counsel, okay, because they don't want to be buying a lawsuit. They want to know that, not only does this thing look like a Corvette, but it has a Corvette's engine in it. It doesn't have the engine of a Pinto. Not that I really know what, I know somebody who had a Pinto like 20 years ago. Probably nobody on this thing does, but that's fine. I guess basically I'm just sad because I dated myself. But let's cruise through here a little bit more. So another thing that's up for grabs and that is negotiated, another document that you work through is the investor rights agreement. The registration rights, these are basically rights that the investors will have to, force their shares to be registered, on the public market so they can sell it to other folks. So that's up for grabs, and what the triggers are for that is up for grabs as well. Rights of first refusal. This is to a certain extent about making sure that you don't have investors in the company that that everybody doesn't want to have in there. What do I mean by that? Well, let's say that you have started a company that has come up with a new document processing or generation, like the next document processing software, right? You may or may not want Microsoft to invest in that, right? Because either they could be a good strategic partner or maybe not. Maybe they're just going to come in and get to know your trade secrets and then try and capitalize on that and force you out. So rights of first refusal are about people who are current owners selling their stock and whether or not the other current owners can obtain that stock. Lockups have to do with, if there is, an IPO, making sure that the investors can't dump their stock, right? I don't know how familiar you all are with IPOs, but one of the things is that, the company releases a fair amount of stock over time, You don't necessarily want everybody dumping all the stock on the market initially, because otherwise that'll cause the stock market price to collapse. Information rights, okay, this is about the investors being able to appropriately get the right amount of information. Some investors, especially if they're non-competitive, will get access to more things. Company covenants are about promises that the company will do to either do certain things or not do certain things. Let's keep cruising on here, because there is much, much more. And I hope that you're all, again, following along on the term sheet and that this is making sense. And you can see, the term sheet itself is fairly lengthy, and there's hundreds of pages of documentation that kind of comes along with this. So we were just on the investor rights agreement. There are also rights of first refusal and co-sale rights. These also pertain to the founders. They're going to want to be able to make sure that the founders can't sell their stock to people who they don't want. If it's not in the company's interest to sell stock to those people. Co-sale rights are about rights that if I'm going to get to sell my shares of stock, under what circumstances would the other investor, Alan in this case, be able to sell his, so that you can both get what's called liquidity, that is cash for your stock, at the same time. One of the sort of pitfalls here is you want to make sure that you don't trigger these things if you're going to be doing some estate planning. So frequently there are carve-outs for this. Voting agreement. So let's talk a little bit about corporate law and how companies are set up and when they're run properly. So you have think of the company as a person. Or think of the company as like a child, if you will, okay? And actually maybe better than a child. Let's just say a pet, okay? And you have the owners of the pet, who in this case are a shareholder, right? But you've got a smart pet. You've got a pet that's like a dog or a cat, or one of those miniature ponies, and it's got a brain, okay? And the folks who are the brain of the company are the board, okay? The board is the group of individuals who meet, or at least talk, and make the decisions on behalf of the company. And then those decisions get executed by the executives. Okay, that's the president, that's the treasurer, that's the CEO. And usually under corporate law, what happens is that, the shareholders get to vote to elect who's going to be on the board. Now, under corporate law, it is permissible for those shareholders to come to agreement so that they will vote in certain ways so that certain people will end up on the board. And that's what we're talking about when we're talking about composition. And when we're talking about that in the context of venture capital rounds, we're talking about voting agreements so that even the common shareholders agree that they will vote so that the venture capitalists will be able to put one person on a seat of the board. Or if it's a 3-person board, sometimes we say VC gets 1 slot, common shareholders get 1 slot, and then there's an independent to be mutually decided. Scale it up, right? We can see 2, 2, and 1 if it's a 5-person board, or some sort of other variations you get sort of bigger. So this voting agreement is about getting in place the necessary contractual documents so that each side can put on the board who they want to have on the board, and so that that board can then make the decisions on behalf of the company. Drag-along rights are about, well, there are a couple things that they're about, but ultimately it's about investors making money, okay, right? Because if they're investing in your company, they want to make a 10x return. This is the model, over a 5 to 10 year period. So what they don't want is they want to, under certain circumstances, be able to sell the company. Okay, we talk a little bit about IPOs. They ain't that common. Okay, there's what's called the IPO window, when you'll see a lot of companies, whether tech companies or other companies, going to market and be able to do IPOs, but that window is not always open. Okay, I think maybe there were 40 tech IPOs this year, maybe 60 last year, like 30 the year before. The much more common way that investors make returns is by a merger and acquisition event. Okay, that is selling the company to a larger company typically. And under that situation, they want to have a mechanism so that they can force the founders or force other people to sell under certain circumstances. And that's what drag-along rights are. You can think about them dragging one of these people along saying, I know you don't want to sell, but we have the contractual right to make you sell. And it's also about, because you can do this under corporate law under certain circumstances, if you get both shareholder approval and certain board approval, you can force somebody to merge, but they'll have what's called appraisal rights. And that is the ability for them to come into court and say, hey, look, court, I know we negotiated this $10 a share deal, but really I should be getting $20 a share. So I want to exercise my appraisal rights and have the court compel the other folks to give me the equivalent of $20 a share. That's very expensive for a company to do. Very expensive for all the parties involved to go into litigation and get through that issue. So, if they're drag-along rights, they can contractually obligate you to give up your rights to get an appraisal. All right, let me just see if we... I love it. Somebody asked, how do you find an independent board member? And then also, would the independent board member practically run the company by playing the founder, investor, board members, author company? Well, who you have on the board is so critical. And when I work with first-time entrepreneurs, we stress this. When we assist entrepreneurs with their exits, especially the first time around, some of we hear, oh man, if I had known better, I would have been much more strategic about who's on my board. It is hard. It is not easy. Typically you want somebody who's got experience in your industry, but is not necessarily competitive, because they can do many things for you. Okay, they can give you general market information that you're not going to have. Especially a lot of startup founders in the software space are fantastic, brilliant software engineers. They've never run a company. They've never sold a product before. They don't have the connections to open doors. So how do you find these people? Networking, okay? If you get the right investors, whether they are angel investors, typically we'll see, you want angel investors to kind of know and be in the space that you're in, because they're going to be more apt to invest, or at least determine whether or not it's a good deal. They may have connections too. So all those things kind of play into how do you get those independents on the board. How do you make sure they don't run the company? Well, I used to do litigation. And so in litigation, we used to, it was a zero-sum game. Actually, it's less than a zero-sum game because the transactions cost involved in paying us. But basically, one side wins, the other side loses. I don't like doing that. And that's why I like transactional law, because, in these situations, everybody's trying to come together to build something that's going to have more value so that everybody is winning. So yes, you're right. It could certainly devolve that the independent board member is the swing voter, but we just kind of don't generally see that culturally if you've been, selected and who you get on there. And the other thing too is if they're constantly playing one side against the other, well then, probably you and the VC are going to agree you need to vote them off. Let's plug along here. Oh, good. And we've kind of we're coming to the end. So moving to kind of in the miscellaneous section, stuff that governs founder stock. So let's talk about this, because this goes back to, the running theme, which is the deal that you cut is really dependent on your bargaining power. Now, what the VCs are going to want to see is that the founders have stock vesting over time. Similarly, they're not going to want to necessarily see you have exploiting voting rights and other things that are going to give you tons and tons of protection. That said, you got a lot of market clout, you might be able to negotiate it. But what they're going to want to see is stock vesting over time. So, at the very outset, you got to get that stuff in place. And if you've already vested substantially, they may make you reset. Okay. Now, we often argue you shouldn't be reset back to zero, but maybe so typically you see either a 3 or a 4 year vesting period with a 1 year cliff, i.e., you get nothing if you leave within the first year. We'll give you, sometimes we'll get credit for 6 or 12 months. All that stuff is going to be subject to negotiation, but you're going to see it in there. So, if you're working to try and have everything completely vested up front, it's highly unlikely you're going to be able to get anyone to invest in your company. They're going to make you restructure that. Kind of similarly, if you've cut too much of a sweetheart deal with your angel investors, if you've given them like a 70% discount on their convertible note, well, that's probably going to need to get renegotiated. And you may say, well, I've negotiated a contract, I can't do that. Well, one of the sort of beautiful things about law is you can come to an agreement, and then so long as everybody agrees to change that agreement, you can generally change it. So that's what they're going to be relying on there. The other thing that you're going to want to see is like a no shop clause. So that means, when you sign this term sheet, you can't go out there to another VC and try and get another deal. I mean, they know, getting back to the bargaining power situation, if you got 2 or 3 different firms, bidding to invest in your company, you can play one off of the other, and you can get a real sweet deal. So kind of once you've locked yourself up, you're not going to be able to shop, at least for a certain period of time. And you may get locked up even before you get the term sheet. It just sort of depends on what you're, what you've negotiated with them. So let's move on, talk about some general pitfalls, and we'll take some questions because we're quickly rolling up on the end of the hour. Pitfalls: negotiating a term sheet by yourself. Okay, one of the biggest disasters that we come across is, especially when it comes to valuation, so many of our clients are brilliant and we love working with them. But they're, they've not done this before. So, they don't really understand the concept of how crucial valuation is, what that basically means, that's how much of your company you're getting away. And the bottom line is, whether you're working with a VC or you're working with an angel, you're working with humans, okay? So many of the concepts of psychology come up, talk about psychological anchor. If you've already said, well, I think my company is worth $4 million and I want $2 million from you. You've already given away, at the end, let's just say you do that deal, they'll have $2 million out of a company that's worth 6, right? So they'll have a third. Is that right? Maybe, maybe not. But once you kind of put those numbers out there, you're laying a psychological anchor, and it may be hard to move from that. Wrong investors, wrong board members. Again, you have to be super strategic about this, and that even goes from the very outset. Getting your board set up correctly. Let's say you have 3 founders. You may not want to put them all on the board. And I say that because, those board seats are very important. And at some point, you may need to take people off the board. And it is harder to take people off and have them be happy than to have never put them on. So, super important. But you want to make sure you get the right kinds of investors, both at the angel level and then at the VC level. The wrong counsel, you do not want to have an attorney who does not practice in this area. Okay, as you can probably just see from the term sheet, and once you've done this a bunch of times, it's not rocket science. Okay, but there are certain ways that things are done. There are certain terms that are kind of standard. You got to have somebody who knows what they're doing. Otherwise, it's going to cost you a fortune. Poor documentation. This goes back to what we were talking about in terms of the diligence process, right? We were talking about how there's sort of pre-term sheet work. You get that term sheet hashed out, then you go into the diligence phase / negotiating these agreements. If you've got poor documentation, that say you've been bootstrapping, and I totally get this, you may have tens of thousands of dollars of legal cleanup to do. Okay, that is, you were cutting licenses with certain people. Those really weren't the right things, or they didn't get properly memorialized. You didn't have agreements in place with your contractors or your employees. Let's say you use third-party software in your code. You know, there can be a lot of stuff that comes out that you got to get cleaned up. Again, securities laws issues too, and making sure they get handled properly. You don't want to be out there doing general solicitations. Again, it's one of those things where there is some guidance on what's appropriate, what's inappropriate, and then there's sort of the whole gray area in terms of whether or not it's gonna fly. It's kind of hard to tell. But you gotta be careful, and you gotta work with counsel on that. One of the really cool things is that in the last couple of years, with the passage of the Jobs Act, there is now actually a mechanism to do certain kind. You know, there are certain circumstances under which you could do a general solicitation. But we're not going to be able to get into those today. So that's kind of it. I know that there were some questions and comments. I'm going to stay on for about the next 10 minutes or so. And, you know, if you've written a question or comment, you know, write it again. And I'm going to start to try and hit as many as I can. And it looks like there's one person who's posing quite a number, which is cool. But if there are other folks, I'll take a couple from Dan, and then if there are a couple of other folks, I'm happy to answer those questions. So then, as I always like to do, I'm going to show you a gratuitous skydiving photo of me here in white, which is, I think, pretty cool. And I want to thank everybody for participating today. I appreciate you coming in. I hope you learned something. You know, we love doing venture rounds. We love working with startup and emerging growth companies. I feel a real kinship for founders because I started my own shop. And that's it. So let's take a look at some of these questions here. I'm just going to take a drink of water real quick. Okay, so I think we're still on here. Do you recommend going around and interviewing a law firm to find out which is the right lawyer for you? Sure, why not? I mean, you know, I think that works. When is the right time to start looking for a lawyer? So what do we do, or what I recommend is, right, I like to do things properly. I like to see my clients do things properly. I understand they have tension with, you know, financial resources, but to avoid a lot of the startup killing issues, once you start working with another person, and it looks like you're going to be moving forward, and you've gotten off of the whiteboard stage, I think it's time to, you know, get a lawyer and get things properly incorporated. The reason for that is that you don't want to inadvertently be generating joint IP in what would be called a general partnership, because it's not really clear who owns the IP, and if there's a falling out, they may very well be able to go out and use it without you, or, you know, trying to do the enforcement of that mechanism. Well, let me take a step back. You know, arguably under patents, they'd be able to, you know, use all their patent stuff independent of you. If it's a copyright issue, they may have to pay you royalties. But bottom line is, it's a real nightmare. So going back to my diagram, you want to be fitting all of those inputs into the company bucket right at the outset. So I would say once you start working with somebody and you get off of the whiteboard, that's when we start talking about incorporation. The other issue, then there are also tax issues that come up. If you've got valuable IP and you haven't started a corporation, then you start a C Corp and you start assigning it, there can be some negative tax consequences that are associated with that. How should you calculate a draft of valuation before you meet the VCs? So I think that falls into the realm of, you know, working with your financial advisors, whether that's a CFO, you got an outside CFO. You know, sometimes you can go and you can work with some guys and gals who are other financial advisors for startups, bankers, those types of folks. But working with them to figure out how valuable is the company right now? You know, what is the present value of the company? You know, is it going to grow to $100 million in 5 years? And, you know, how likely is it for me to get there? You know, they can work on that, and they can help you determine, yeah, you know, even though the company is going to be worth $10 million in 5 years, its present value is going to be worth, did I say 100 million in 5 years? 100 million in 5 years is worth 10 million today, or something along those lines. So, bottom line is, there are a few ways that they do this. Okay, this is not what I do, but they take a look at comparables. Okay, they take a look, if you Google, they take a look at Yahoo's who was out there at the time, or Ask Jeeves, or all these other things. That's what they do. They take a look at the market opportunities, right? If you're kind of in a new area, and this is sort of one of the harder things to do, but let's say you're the first social network. What is the value of a user? How many users can you get? I mean, it is definitely more art than science, but that's what these people do. And then building a well-articulated case for why the company should be valued at X, that's what you should be doing, and that's what those people should be helping you with. And then you got to make your case. And there's not like, that's one of the things is it's not like there's a standard of weights and measures where you can like take a company and they're like, yes, I bless you, and you are worth $100 million. It's all subject to negotiation. So the better you can make your case, the more you can bring in your advisors to help you make that case and put together a rational, cogent argument. That's what you need to be doing. Do we introduce investors? The answer is sometimes. Okay, I never make any promises that we do that. And the reason for that is that my connections, whether they're with my clients or with folks who we've developed relationships, are very important to me, and on both sides of it. And I want to make sure people are getting good fits. So I certainly can say that we have, but I certainly say we never promise that. There are certainly attorneys who probably make those promises behind closed doors. That's not what we do. I always like to try and connect people who are good fits, or at least who I think will be a good fit. And I don't know, a client who walks into my office, or a potential client who walks in my office, whether or not they're going to be a good fit for somebody I know. So I never make a promise that they're going to. I mean, that goes on both ways, whether it is on the investor side of things or, other legal issues. I can't tell you that I know every attorney who's out there. I don't. We work hard to try and connect our clients to the people who can help them grow their businesses, but, we certainly don't know anybody. But we certainly work really hard to try and support our clients. So safe versus convertible notes. Do we recommend for a founder safe is always better, in my understanding? Is that correct? Well, safes are becoming more and more popular, I'll say that, especially with investors who have been around the block. There are arguments that it's better, i.e., there's no debt associated with it, so theoretically that debt couldn't be called, and that investor can't force you into bankruptcy. Some of the downsides are, and this is kind of beyond the scope of our conversation today, but some of the downsides include that some of these things, whether they're available by Y Combinator or 500 startups, like I think the KISS convertible note or whatever, there are some things that are important, and they involve potentially the ability to have the terms of the notes amended by simply a majority of the outstanding note holders. And when I say that, I mean, rather than having to go to each note holder, you may want to be able to just get sign off by the majority. So for example, if you've issued $1 million in notes, you just need to get 501,000 worth of notes to sign off on it. The reason for that goes back to what we were talking about earlier, bargaining power. If you cut too sweet a deal with your seed investors, you may need to recut that deal. So not all of those instruments like safes and KISSes and stuff have that built in there. It's definitely something you need to take a look at. I will say there is value in the sense that, the more kind of mechanization of these initial founding documents that are out there, most startups don't make it. So, if they're not spending a lot of money on legal, arguably more of them can at least give it a shot, but it also arguably leads to more cleanup and more issues at the venture capital round. But yeah, I think safes are pretty cool if depending on the situation who the investor is. Do we have to disclose the IP details to the VCs? Well, most likely during the diligence part, you will be. They're going to want to vet your IP. Um, you're not going to want to do that early on, and you're going to want to be circumspect about it, making sure that it's strategically right. But I mean, right, getting back to sort of the metaphor of making sure that that Corvette actually has a Corvette engine in there. At some point when it's appropriate, they're going to get to take a look at it and kind of pick it over a little bit. If preferred stock is structured without any convertible and no multiple, how much portion does the investor get at the time of a liquidation event? Well, I'm not sure I completely understand the question, but it's possible, okay, that they could have no liquidation preference, and if they have no liquidation preference, then they get treated as a common stockholder. So they would get whatever they got if they had common stock. Now, one of the reasons why we issue preferred, one, it has more rights and privileges than common stock. But the other reason is that you want to have, generally you want to have the argument that the value of the convertible note, your convertible debt, is different than the value of the common stock. So that when you're granting shares of common stock to employees or giving options to employees, you can have a lower fair market value for that stock so that the employee doesn't have quite as big a tax ramification. Now, I don't want to get into more depth than that at this point, but basically the point is the more bells and whistles that you have on a convertible stock, the more better an argument that there is that really the convertible share is worth a lot more than the common, and so you should be able to issue common for less, basically. So I've gotten some positive feedback. That's fantastic. I'm happy to chat with folks. You can send me an email, and we'll get you scheduled. I have a few times they're coming up, but I'm also doing a little bit of traveling, so it might be a little bit of time. Unless there's a super urgent thing, like you have a term sheet or something that just landed on your desk. But happy to chat with folks. And my assistant can help schedule that. I got some questions regarding the investment from China and transfer of the Chinese currency to dollars. Please discuss investment from China and the transfer of dollars. So, I am certainly not an expert in terms of capital flows in the sense that, I know what the law is to get currency out of China. I know that there's a fair amount of law out there that, keeps folks from China from exporting their money, basically. And I wouldn't be competent to talk about that now. I can certainly talk about how, if there are Chinese investors who have, money here already, what it takes to get that, get those investments done. And, so some of the things that we take a look at is, with the applicable securities exemptions would be typically it's like a Reg S. But in terms of, vetting the money and making sure that there's not an issue with, organized crime, either on the outbound side from China or the inbound side here, that's not something that we typically handle directly. We don't typically, I can't say that I've handled with Department of Energy grants. Most of the work that we do is non-government related, but I'd be happy to chat about that if, if you think that we might be a fit. So I think with that in mind, I think I've answered all of the questions and folks have dropped out. So I want to thank you all once again for attending. I hope that you've learned something. I hope it's been helpful, and have a great afternoon. Take care. Bye-bye.